All right, let's talk about something we all think about. We've all got stuff we simply can't afford to lose, right? Our homes, our cars, our ability to just make a living. But what happens when the unexpected strikes? Well, today we're diving into insurance. It's this incredibly powerful tool that's all about managing those big, scary risks, both in our personal lives and in business. I mean, it's the question that's always kind of sitting in the back of our minds, isn't it? We all hope for the best. We plan for the best. But life is, unpredictable. So what actually happens when things just don't go according to plan? These are the kind of risks we can all picture. A fire ripping through your home or office, a serious car wreck, or even just someone having a bad accident on your property. The financial hit, not to mention the emotional toll, can be absolutely massive. And that, right there, is the core problem insurance was invented to solve. Okay, so what is insurance, really? At its heart, it's basically a system of shared risk. You can think of it like this. A whole bunch of people pay a little bit of money, that's your premium, into a big pot. That way, if something awful happens to just one person, they don't have to carry that huge, crushing financial weight all on their own. It's a contract, a promise that an insurer has your back if a specific loss happens. But this whole system doesn't just work on a whim. It runs on a really solid set of rules. You could call them the rules of the game. They're there to keep things fair and make sure the whole thing works. So let's break down these 5 core principles. First up, we've got insurable interest. Now, this one is a huge deal. It just means you have to have some skin in the game. You can only take out an insurance policy on something if you personally would lose money if it got damaged or disappeared. And the logic here is pretty simple, right? You can insure your house because if it burns down, you're the one who takes the financial hit. But you can't insure your neighbor's house for that exact same reason. You don't have a financial stake in it. No stake, no insurance. Simple as that. Okay, principle number 2 is utmost good faith. This one is all about complete and total honesty. The whole insurance contract is built on a foundation of trust, and that means you, the person getting the insurance, have to tell the whole truth and nothing but the truth about all the important details. So, for example, let's say you're applying for life insurance and you have some kind of long-term illness. You absolutely have to disclose that. If you try to hide that kind of crucial information, it could completely void your policy, and that would mean no coverage right when you need it most. Next up, we've got principle number 3, indemnity. And this one is super important. It basically means that insurance is there to put you back in the exact same financial spot you were in before something bad happened, not a better one. It's not a winning lottery ticket, right? You can't actually profit from making a claim. Here's a good example. Say a business insures its building for €400,000, but if the real market value of that building is only $250,000 and it burns to the ground, the insurance payout is only going to be that lower true value of $250,000. Indemnity makes sure you're paid for what you actually lost and not a penny more. And following right along from indemnity is our 4th principle, contribution. This rule is designed to stop people from trying to game the system. You can't insure your car with 2 different companies, have it get totaled, and then try to claim the full value from both of them. Because, well, that would mean you're profiting from the loss, which goes right against that principle of indemnity. So, if your €10,000 car is insured with, say, 2 different companies, those companies are going to talk to each other. They'll work together to share the cost. You'll still get your full $10,000 back, but each insurer is only going to pay their share. It's a built-in check and balance. And that brings us to our final principle, subrogation. Now, it sounds like a complicated word, but the idea is actually really straightforward. Once your insurance company pays out your claim in full, they get the right to step into your shoes and go after whoever was actually at fault to get that money back. Just imagine your €20,000 car gets written off because some builder negligently left a huge oil slick on the road. Your insurance pays you the 20 grand. Well, subrogation means they now have the legal right to sue that builder to recover their costs. It makes sure the responsible party is held accountable, and it helps keep premiums down for the rest of us. Okay, so now we know the rules of the game. Let's take a look at how this all works in the real world. From the moment you decide to get a quote to what actually happens when you need to make a claim. The whole process follows a really logical path. It all starts when you reach out to an insurer. Then you'll fill out a proposal form, and this is where that utmost good faith principle is so important. The company then looks at all your info, assesses the risk, and calculates your premium. If you agree to their offer, they issue the policy, and boom, you're covered, ready for whatever happens. And when that time comes and a claim is approved, the payout usually happens in one of three ways. They might give you a cash payment, they might replace the broken or lost item directly, or they'll pay to have it repaired. But the goal is always the same. Get you back to where you were financially, just like that principle of indemnity says. Now, those principles we talked about, they're universal, but how they get applied can look pretty different depending on the situation. So let's compare the two big worlds of insurance, business insurance and good old personal household insurance. The biggest difference really just comes down to scale and complexity. A business faces a huge range of risks. We're talking everything from employee lawsuits to supply chain breakdowns, and the potential financial damage can be massive. For household, the risks are obviously very personal and very serious, but they're usually a bit more contained. But having insurance is really only one piece of the puzzle. The smartest way to handle things isn't just to prepare for a disaster, but to actively work to stop it from happening in the first place. And that's what we call risk management. A smart business, for example, is going to take proactive steps. They'll install fire sprinklers, put up security cameras, run safety training programs for their staff. These aren't just good ideas, they actually lower the chances of a disaster. And insurance companies, they love to see that, and they'll often reward it with lower premiums. It's a total win-win. And for all the differences between business and personal insurance, it all boils down to two really important similarities. First, both businesses and households absolutely need insurance to protect them from a major financial shock. And second, both have to play by the exact same set of rules, those 5 core principles we just walked through. So there you have it. We've gone through the contract, the principles, and how it all works in practice. We've seen how this amazing tool helps us manage life's unpredictability. Which leaves us with just one final question to think about. Now that you know the rules of the game, what risk in your world is worth protecting?